let's take a look at the primary lines so we can have an idea on how to be using charts to determine whether some of the things that we are drawing are critical or they're just pretty much everyday lines and they're not as important. Once you understand that there are some lines, especially on the charts, that are more important than others, some things start to become clearer than usual. And so here we're going to talk about primary lines on a chart and why they should connect to one of the following 3 points. Now, the way I've set up this video, which I hope is going to be a short one, is this is the most important point right here. If your line, and I'll get to that in a minute, if your line is touching an all-time high, that's an important line. If it's touching a 3-year high, that has importance too. And if it's also touching a 52-week high or low, remember, we are talking the line should either be touching a 52-week high or a 52-week low. So it works on both sides equally. So, and what I mean by that is, let's say you have a stock or a market or an index. It doesn't matter whether it's commodities, the general market like the S&P 500, or it's a stock, any instrument, currencies, it doesn't matter. For example, if we have an all-time high right there, right now we can say that the all-time high for the Dow is about 14,000, which it made in November of 2007. So that's an all-time high. So if you can find an area in the chart where you can draw a straight line, let's say connecting price, you can use this for connecting both price or indicators. And indicators, if I can. It works for both either price or indicators. And because we use the RSI for the most part, RSI, sorry, or the MACD, this is also important for these two indicators. Now remember, these two technical indicators. But remember, let's just do price for now, and then we'll get to the RSI. But let's do price. So let's say you have a Dow makes a high of 14,000, drops lower in 2007, 2008, 2009, and then at some point in price. Now these are the highs, so it makes a high there at some point, another high. So now you have this point and this point, you establish a straight line. So what I'm trying to say is the next time you see this instrument move above this, break out, in essence, move for the first time, move above this line, which is connecting to an all-time high right there. This is a primary line because it's connecting it to an important high. So any buy signal from that range is going to be a stronger signal than, let's say, maybe the market. Let me try and just wing it here. Let's say if there was another bump here and then the market went high. Let's scratch this off. So there was a line for connecting that high and that high. Even though the instrument did move above this line, the red line here did move up and it was a buy signal, but it was not an important high, because if you extrapolate this line, see whether I can, let's use a different, if I extrapolate this line, it doesn't connect to my all-time high. I want a line that connects with an all-time high. Let me start this again, because it's very simple actually. So you have a high, and so this is a price in price. So markets goes up, down, and then so you connect that high, this high and this high here. So you have a straight line, 2 points make a straight line, so you draw a straight line. So this market might be moving up, down, up, down, up, down. At some point maybe hit this line, down, and then break out. Okay. Now we can also say that there was another line. See whether I can use black. You can take this high and maybe connect to that high, and you have a line here, which I'm not drawing very well, but needless to say, because this high, if you extrapolate this line, it's not connecting to my high. So any breakout of this black line is not significant. On the other hand, a breakout above the actual line that connects to the highs, this line here, the blue line that connects to the highs, this breakout above this line is significant. It's an important development. It's one that you can take advantage of, and the reason why you want to take advantage of that kind of price action is because this is where you get the biggest price moves. Okay, you get big price moves, especially if you're in a situation where the market has gone down and you're looking for a turnaround situation. Now, it happens exactly the same if you're using price or if you are using the indicators, because indicators like the RSI will have ups and downs, and so you draw a straight line. If it's connecting you to the high, either one of these highs, and the most important one being the all-time high, because that's an all-time important point, 3-year high, because that seems to change things around, or a 52-week high, you'll see the charts move up and the buy signals are more important. Now, it happens on all time frames. Monthly charts, it works for those. Weekly charts, it works for this one too. All charts, daily, it works for this one. Yes, hourly, like I said, all time frames. Now, hourly, yes. Problem is, you're not going to find the hourly chart giving you a lot of buy signals, because, you know, the hourly charts, let's say, you're not going to find, most charts don't go back on the hourly for more than 6 months. So the Dow made a high, I'm just giving a Dow as an example, in 2007. So on your charts, you're not going to have the significant high from the Dow, which was about 3-4 years ago. 5, well, it's about 4.5 years ago. Okay, you don't have that high on your hourly charts because the data is not enough. On your dailies, difficult now, because the Dow has been trading about 4 or 5 years after the high in 2007. The weeklies depends on how long you have your weekly chart, and on the monthlies you'll definitely see that. So you need the market to move above this. So now let me talk about the lows. Remember, this works for both highs and lows. So let's say we have a point on the chart. Stock comes and hits a low, and then has, oops, let me check this call. Anyway, sorry about that. So one thing we can do is, let's take a look at the opposite, which is stocks making new primary lines connecting to a stock's lows. Remember, it works for price, it works for indicators, and I'll have some examples for you in a little bit. But anyway, so a stock makes a low in price, and over the many following weeks, days and months, it moves higher, makes a low, moves higher, makes a low, moves higher, makes a, you know what I mean? Just as it keeps high. Now, it's going to establish, based on this low, it's going to establish a line, a straight line. Okay. Now, it's going to bounce over. Now, remember, you don't make these lows, the market does. So at some point, it's going to establish a line. Now, it's not always going to be perfect, but at some point in the future, don't be surprised that this stock breaks the trend. Right there, it breaks the trend. And on breaking the trend there, because this trend is connecting to either one of these points, all-time high, all-time lows, 3-year lows, and 52-week lows. This becomes a significant sell point, because what that means is that this is the big trend is done, and usually what happens, you get a bigger move than usual. Remember, even though the stock was pulling back here, pull back here, pull back here, and pull back here, and was trying to bounce, this break, generally this break is the one that now sees the biggest drop since this move from here to here. Now you're going to see the biggest drop, bigger than these drops here, 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 which were actually drops on an uptrend. The trend in the market was up, or the stock or the currency was up, right? As it bounced off this line, the trend was up. But once it broke this trend, which is a primary line, it's a primary break, then this is going to lead to a big move, bigger than the current, than the other shallow pullbacks. So you have to be careful for things like that. Now, another thing I need to probably point out here is some of these lines are not always going to be perfect. You'll realize in some charts, and I hope going through my examples, I'm going to go through some, is that sometimes you'll notice that you have to adjust your chart slightly. In other words, maybe this line, the actual low was here. Maybe that's not a good, but anyway, the actual low was slightly below, but when you adjust your line, it connects this low, that low, that low. And yet here, it didn't hit the low. It hit slightly above the low. Or sometimes it's going to be slightly under the low. In other words, you want to find the most consistent straight line. But you also don't want to tweak it too much because that leads to confusion. But I'm just saying, if you're ever finding yourself adjusting a little bit just so that you get a nice straight line, it's okay. Because remember, it's not supposed to be exactly on that line on the lows. It's supposed to be in that general area as much as possible. Now, what do I mean about the low? We are looking, and this is very important, when drawing your lines, we are looking at the close. If you are looking at an hourly chart, you want to consider the closing price, not the intraday low or the intraday high, right? So you want the close. The closing price is what you want. Because what is going to happen, let's say you have a weekly chart. Let me get that off. Let's say you have a weekly chart and you have stock comes, makes a low, and then closes there. That's the close. And then the following week, it moves up and down, and then at some time it makes a low, an intra-week low, but it closes there, and that's the high. And then down the road, some more action. You have now, but you've already established this close and this close, so you establish a trend. Remember, you're not drawing a line, you're not drawing your line connecting these lows, even though you can, and some people do. In my thinking, you want to use the close, which is the most important part. So you want to take this close and this close, establish a straight line going through the closes, okay? And so even though at some point, see whether I can get this right. Even though at some point there might be a drop during the week, but it's not unusual that stocks recapture this line and close exactly on the line. So this action below the line or above the line is not what you're looking for. It's actually the close. So that is going to help you draw lines. Okay? Just remember that. You want to use the close. So remember, it works the same way. So now you've established a line, and because it's connecting to a primary low, let's say this is a all-time low right there. So once this trend is broken, it finds support here, but once the following week, if it breaks it and closes below that line, irrespective of where the high or low, once it closes for the week below that, it's a break of this trend, the black line. So here, because of this trend being a significant trend line, a primary trend line, because it connects it to a primary low, this selling point is very important. You want to sell because the pullback is going to be very strong. Okay? Now, which also means, and I'm going to do this just for the highs, which also means, let's say you have a high here and then another high there. So let's say you have this as your primary line. But because of the way the stocks move, at some point down the road, there might be other lines, maybe a line here, a line there, a line connecting another high. There could be lines connecting, these lows and other points in the. So all these lines, some people are going to use them, but what they don't realize is that the most important line of the ones I have drawn is this line here. The one this line here, the one that I'm circling with green. I try to circle with green. This line here, because it's the one that connects the primary high, so it's a primary line. Okay? Once you get that, things become very simple. Now, let's take a look at some examples here. Now I'm going to go to the Dow, to the NASDAQ, monthly. Remember, it works for all time frames, but I just want to show you how things work. This is the NASDAQ 30-year monthly chart. That's kind of hard to say, but you'll notice somewhere around there was an all-time closing high. During the bear market of the tech bubble, if you draw a straight line connecting those highs, it's only until 2003 when we moved above this line in price that we had a move that took the market from 2003 to this level here, because we broke a primary trend line connecting a serious high. Now, even though you might not see this in the chart at first glance, but there's a lot of information here. That's why I'm using this. Remember, as this market moved higher, it was breaking a lot of primary trend lines. For example, there was a primary breakout there. This was an all-time high in the NASDAQ right there in 98. Once we broke out there, you had a huge move, because breaking out above a primary line is an important development. You also notice in 1994-95, we broke out. There was a trend line there. Because this trend line was connecting it to a primary high, which was an all-time high on the NASDAQ, which it made in 94. Because once it broke out there, right there in sometime in 95, January or February or March, once it broke out right there, that was a primary breakout, and so you had a primary move. Okay, now also notice that, because let's flip here, because this is 2002, 2003 low right here. And then over the next 4 years, now 5 years till 2007, we had a trend line was established here. You see what I'm saying? A trend line was established. Now, even though it broke here, and it did, this was good for a big move. It was a 1 month move, but it was significant, okay? And this is probably a good way of explaining things, is because markets are not 100%, it recaptured. So now what you have to do is that this line should actually be different. It should be reflective of this new line, because this low right here, let me try and get this right. Let me draw another line a little bit straight so you can see what I'm saying here, because this connects to that low, and then I'm gonna try and get it right, connects to that closing low right there. So you have a straight line connecting these points. Now draw a straight line right there, okay? Because this is 5 years. This line is almost from 2002 all the way to 2007. That's 5 years. So this is more than a 3-year low. You want it to be at least 3 years or more for it to be a significant low. So once we broke this trend line here, you see that led to the drop of the bear market of 2008, 2009. That might not seem like a big deal, but notice again. Now let's draw and look at the RSI on the monthly. The RSI, take this low right there, sometime in 2002, connect to that point right there, and so you have the beginning of a line. So connect those lows, that low, that low. Now remember, right here, there's a little bit of a blip. In other words, right here, right there, about 2006, it seems like it went slightly below and then back. It recaptured. Now, I want to tell you something while I'm on this point. Every time you see something like this, something break below the line and recapture it with what seems like uniform activity, like right there looks like a V, and this here looks like a perfect V right there. This is usually a trap. Okay, so you want to draw your line and still keep it above this V. In other words, you want it to look like it did here, because this was a fake move. So discount the fake move, but you don't want to do it so often, because sometimes it leads you to draw strong lines. So it's kind of like you play around with you play around with the lines to get what seems like a line that makes sense. And if you had used the line, it could have made you money or could have put you in a good side of the market. Needless to say, we can draw this line two ways. We can draw this line with above the V, like we can draw this line. We can draw this line again, like I said, keep the line and notice that it had a V recovery, so just keep the line like that. Or we could still draw the line like this and come and connect and respect that low. Okay, we can do it both ways, but it still gives you the same similar line, because now we would have a line that connects it to that low and then still. So in other words, the break in the market as far as the RSI was concerned was right there, beginning of 2008. Once we broke that trend, that was a primary break. Now, the reason why I predicted the crash of 2008 is because the crash of 2008 was, to me, easy to predict, because I took the lows of this 2002 and connected to the lows of February or March or January of 2008, drew a straight line. And once we broke down here, that little break, it told me, because this was a primary line connecting almost a low in the RSI going back about 6 years, 6 to 7 years, all right, roughly about that long. Once we broke that trend, the RSI broke below this line here, the turquoise line, I knew there was going to be a significant sell-off, and that also corresponds with this area in the market. And I hope this responds to that area in the market that connects these lows and the lows right there. Now let me draw that a little bit different, and I'll tell you why. I might have to cancel all those drawings. I'll tell you why, because I need to, the closing lows are somewhere here. You see that closing, so it's a little bit higher right there. See, that's the closes of this are right there. How do you know a close? Because this is an OHLC chart. In other words, let me explain that. Every bar you see here has 4 points. It has an intra-month low, intra-month high. He had the monthly opening price, and it has the monthly close price. Each line you see here in the price, and I hope you understand. So this one is called a OHLC, which is open, high, low, close. So every line here, as you can see, this was an intraday low right there, but the weekly close, you can't see it because it's kind of a lot of data, but you're looking for on the line, you're looking for so the close was somewhere around there. It's hard to see, but I hope that does make sense. Needless to say, what I was trying to say here is, so if you use the price, you'd still have realized there was a significant sell-off in the market, because once we broke the lows connecting that low, and the lows here, once we broke down there, you knew there was going to be a significant sell-off in the market, because you are breaking down in a significant trend line. Okay, so definitely you're going to get a strong move when you get that break. So remember, it works both ways. A primary line was broken somewhere there, which led to a strong rally. At the same time, a primary line was broken here, which led to the crash of 2008. So without really going into too much details, you see that these are primary lines, or there are some lines in the market that are important. So which means every time you want to buy a stock, you have to make sure, for example, this high, right, is significant, because this is the NASDAQ's all-time high, March 10th, 2000. So this high, every time you have a breakout that connects this high, for example, if you draw a straight line there, because this line, this RSI was moving outside or above this line here, which was a primary line, you have this move from here, this move here in RSI. And as this RSI moved higher, so did the price. Okay, now notice now we have a primary line here, which is NASDAQ's all-time high. We made a 2008, 2007, late 2007 high. If you draw a straight line, you come and find that at the highs of May 2011, we hit this primary resistance line. It's a primary resistance line because it connects a primary high. See what I'm saying? So that's a significant sell point. Once you see the resistance take place, you know that that's going to suggest that that market has seen a significant high. And we can state right now we've seen a significant high in the market because market was down as much as 20% since then. Now if I can run through some other charts quickly, just so that we can have color, I want to go to the Chinese market because it had a strong rally going into the Beijing Olympics. Just want to show you how things work out if I can find it. I want the monthly chart. Okay, going into the Beijing Olympics. Let me see whether I can make this time frame a little bit longer here, so we can have more data. Good. So we are looking at a very long-term chart for the Chinese market. Now, of course, you can see this big move here. The Olympics were in 2008, and about a year before that, there was a huge move, right? So, but notice if you take this high, which I believe was an all-time high, or at least a 3-year high. We know it's a 3-year high because by the time we come to 2006, the high we can see here is 2001, so that's 5 years. Draw a straight line. Once you break out above this major trend line, you have a huge move. Now remember, a line that connects this line here, connects this high, unless it was 3 years, it was not a very bad line because this is a monthly chart. So this we're talking about from 2004 to 2006, so about 2.5 years. So this is at least, you can say, a fresh 52-week high. So remember, 52-week highs are also important. So a breakout here was not primary, but it was an important secondary breakout line because it connects it to at least a 2-year high. Even the trend break here in late 2003 was okay because number one, it was connecting it to all-time high, and you had a move that took it up about 4 straight months. So if you were playing the Chinese market at the time, you would have been at least getting good stock picks. So remember, it's not perfect, but you're never going to see a move in the market without a major trend break. Notice now, if you take a look at the RSI, now remember, you want to use it. Now remember, the RSI high is here, yet the next RSI is lower. Usually you want to use the RSI that corresponds to your price high. Okay? Because that's the high that is important. Remember, you want to use the chart to tell you what is important. So the important is not, even though this one is slightly higher, this node here is slightly higher than this one. Hope you can see that, right? Slightly higher, but the important one is this one that connects it to the high right there. So what you do easily is you just take this high, even connect 2 of them if you have to, but take this high, and you'll notice, just for the sake of example, is when we broke out right there. Remember, there's another node there which confirms. Whenever you see nodes that confirm a line is straight, you know that line is correct because there was a high there and there's a slight node right there beginning of 2006. Let me take that off so you can see that node right there. That right there is a node. Little bump right there. See it? So if you draw a straight line connecting that high and that node, right there was your breakout point because these 2 nodes confirm that this line is straight. So this breakout point it seems now that we know that it's a primary break, don't be surprised that we saw this instrument here move from here all the way, which was about 1250 on the Chinese market, all the way to 6,000. I mean, this is a major move. Again, like I said, it all began with primary break. Now notice on the flip side what happens. So this is 2005 low, another low here, draw a straight line, which is a blue line. Once we broke, and another node here, we tried to bounce off this line here, right there, but we came back and stalled. Once we broke that in 2008, which connects it with that, which also connects it with another major trend break, which is if you draw a straight line connecting the closing. In fact, if you can even draw it, let me just draw it this way. Straight line, somewhere around here we broke down. This was a major, almost a three year low. You draw a straight line there, you break that, a major break, you got a sell off, which is coincides with the sell off break here. Okay, so you had a big move which took the market from about 4,500 all the way back to about 1,750. So net what I'm saying is, at the end of the day, you just have to watch what the stocks are doing and follow the trend, major trend lines. So right now, let me see whether we are making, if I take the low of 2008, late 2008, and draw a straight line, which is a red line, you'll notice that now we broke that over the last 2-3 months, which corresponds with this break again of this gray line, which is almost a 3-year low. This line is important, this because it's three-year low. 2009, 2008, 2000. It's 1, 2. Let's say 2.5 years. So it's a 52-week trend line. Either way you want to look at it, it's a major high. It's a major, and also connects to it. If you continue the line, touches these lows here. Really does. So somewhere around here we broke this. So this is a primary break. Hence the reason I've personally been I've been negative on the market because of these breaks. Things like this lead to sell-offs in the market. So, you know, I could go through many charts. Now notice the same thing here. It works for RSI, it works for MACD. You'll notice that this is a low on the MACD. If you have a 3-year break of that right there, you want to sell because this led the Chinese market to a bear market. That break of this red line on the MACD right there, connecting those lows, and there was a node there, it's to a straight line. Once we broke below that, it was time to get out of that market. Also, notice the main MACD could be breaking a trend line to the downside. The main MACD could be breaking a trend line there. That's why I have the question mark. My question mark is, are we going to see further lows in the market? Now, I promised to make the video short, but I think I might just stop there. But let me take a look at one more, which is gold. I'm going to take a look at gold because gold has had a phenomenal. Let me take a look at the VIX. Just go, because remember, it works for all time frames, all charts, everything works for everything. So this is just can be repeated on any chart that I pull up. It doesn't matter. I just looked at the VIX here during the crash of 2008. You notice that the VIX, this is a monthly chart going back 2002. There was a trend line in the closing prices on the monthly right there. This is a month. See all these areas here were just intra-month price range, but they didn't close there. They closed, the highest close is right there. And that high right there is highest close in 2002. You draw a straight line, which is a blue line. Once we broke out here in 2008, above this primary trend line, we had a spike in the volatility that has never been seen before, and we had the crash of 2008. Right? Now we have the VIX breaking out above the highs of 2008. Connect that high there, you have a straight line. Once we broke out there, corresponds with the VIX moving from about 17 or 16 all the way to about 46. So that small observation was good for that kind of a move. Primary trend line break, which was an all-time high on the RSI. Remember, the RSI has never been this high. The price was never this high, so this is a significant level. So you break out here, you get this big surge. Notice that the closing price was there in terms of price action. Come here, connect this closing high there, draw a straight line, which is a black line. Again, once we broke out there, it was a primary break to the upside. And so understanding primary lines is very important. It's not all lines are made the same. Okay, and that's why some of the hourly charts are sometimes not as important, because they don't have the important highs in the charts. I hope that makes sense. If a stock, the hourly charts probably are good for 3 months, have 3 months of data, but the high could have been years ago, so they don't have the important connection with the important areas of the chart. I want to just discuss crude oil here. Discuss gold before I stop here, is because gold has had a significant move over the last, I would say, 9 years. And I'm trying to get a monthly view. Okay, here's a monthly view for gold. Now, you'll notice one of the reasons why gold has been on fire is because look at this green line here, connecting that RSI high and that high right there. Let me take that off so you can see it. So once we move above that, it's a significant breakout because it's connecting it to a significant high. This here was almost a, it was, I think, it was an all-time high going back to about the 80s. So it was almost a 20-year high. Also notice that this 20-year high, and I'm just taking, you can take any point in this chart. There was a trend line there, was broken out. Once you break out, you got a significant buy point. Another trend line there, significant buy point. Another trend line there, because all these are major highs, as gold has been on fire for many years. Another trend line here, major high. Another trend line break there on the RSI, which connects to this area here, which connects with this breakout here, which was about gold at 700 and went on to touch 1900. Okay, so I hope that helps you understand. I'm sure I've gone about it over and over, but you're gonna see the same thing in many charts, that sometimes, like right now, and it's important. Let me finish this video here with something of relevance, and it is, I'm gonna go to the, let me take the NASDAQ or the Dow. The Dow made a fresh 50, this is now current, the Dow made a fresh 52-week low about 5 days ago. Fresh 52-week low. Okay, so now, because it only made those lows about 5 days ago, the hourly charts, this is what I was trying to tell you, the hourly charts are very important, because the hourly charts have a 52-week low in the chart. Okay, and that 52-week low, which means corresponds with that RSI low. So which means at some point, should the Dow break a trend line on the hourly, should it move below this blue line, which connects the lows on the RSI, which the lows correspond to a fresh 52-week high, if it breaks this trend, whenever it does, you're going to see a significant sell-off in the market. Even though today you see the Dow up 286 points. That's why I pointed out on Twitter, be on the lookout for a turnaround. Let's watch for a reversal. I think it's coming either today or tomorrow, in the next couple of days, because I think this hourly has a significant RSI point. Let me show you the New York Stock Exchange hourly chart. You'll also see the same thing, even though it's up 3.2%, which is a huge move in a day, but it has a 52-week low on the chart. So this chart is just not every other chart, because it has a significant low in the chart. That tells me that should we break let me draw that different. That tells me that should we break this trend line here, which connects, I'm gonna try one more time. Just give me one more. If I draw a trend line connecting right there, if at some point in the coming hours, maybe into the next day or 2 days or so, if we break that line, it's not gonna be good for a few points to the downside. It's gonna be a huge drop because it's gonna be a significant trend line break. Okay, it's gonna be a significant trend line break, and those are the things I'm looking at, which also means that any break of this trend line here, that this low corresponds to the 52-week low here. So even on the MACD, should we break the trend, this trend be broken to the downside right there, you're going to see the market sell off hard, because that's going to be a significant pullback, because you're breaking a significant low. And why is it a significant low? Because it's hitting one of our important 3 levels, which is fresh 52-week lows for this. Now it's lows, not highs. And that's how it works. Now, maybe I should finish this video with a slight twist here, and which is leave it on a positive note. Go back to the Dow 1 year daily. Now you'll notice that the Dow made a 52-week high in May. Notice what happens once we broke out above this trend line, because this was a 52-week high. Once we broke out here, right there, we had a significant rally over the next, it had almost a straight move to the upside. I think, in fact, in most markets like the NASDAQ, we made fresh 52-week highs, intraday highs. Now, which means that now, you see this line here? Many people are trading this trend break right here, because this line connects this highs and this high and this high. So many people are playing right now, maybe not understanding, I believe, that this is not a significant trend line. This here is not a significant trend line. Why? Because it's not connecting it to a 52-week high. The 52-week high line is going to be one that connects that high, so it's going to be somewhere here, which is going to be down the road. We're talking 2 years, 3 years down the road, are we going to break this trend line? Okay, now coming off, let me show you just one more chart, because coming off the lows of 2009, I have to go to monthly charts because that's where we see the all-time high. No, it's not a good one. Let me find one that has done great. Yes, coming off the lows of 2009, the best way to have owned turnaround stories was to find stocks that had a high, like that one, and they had direct lines. In other words, this one you could have broken out anytime, because the high was so high, any line is going to be a major trend line move. You see what I'm saying? You can draw any line, like right there in 2010. It broke out above a line, because this, any line you draw on the monthly is going to connect to an all-time high. The RSI also, like this here, when it was breaking out here, which was 2009 lows, right there, because this is a 1, 2, 3, 4, 5.5 year high right there. You connect, we change the color here so don't confuse you. You could take this high and draw a straight line. So this breakout here corresponds to this stock trading here. Might not seem like a big move until I change the chart, because this is almost all-time data chart. Now let's move it to 3-year high, 3-year chart. That's why you see it move the stock from 75 cents, give or take, 75 cents area, all the way to about $5. That's a huge move, huge. So you always wanna, if you wanna own the best stocks, you want them to have direct access to to a major high. In fact, since there's so many stocks in the market, it's worth your time to find stocks that have a major connection to an all-time high. Let's try one more chart here. Since the video is already long, heck, let's just roll with it. Okay, like this stock here had a major run. This stock had a major run off the lows of 2009, but notice it had a major trend line break. It connecting it to that high, which is a bear tech bubble highs, which pretty much prices were just inflated, and that high, you draw a line, you had a major break. So anybody who was looking for stocks like we were in 2009, we were looking for stocks that were breaking out of major trend lines, and we had this major move. Okay, but also notice even here, it broke out this breakout here. The trend lines don't have always to be like that, pointing higher or pointing lower. Trend lines can also be straight, because you see a trend line could be that the stock has been trying to move out of a range, then finally breaks out. So this trend line is still a trend line. It doesn't matter whether it's straight, flat, diagonal, it's a trend line. And here you see it broke out right there in the middle of 1999 from about $5 all the way to 105. Huge move. But remember, that was 2000 and everything was crazy back then. Anyway, I think I've talked about primary lines for long enough to where I believe you get the gist. You want your lines to connect to a major high. If that high is not one of these, then that line is not primary. It could be a secondary line, tertiary line, or just not important. But that's pretty much what you want. The more they connect to the highs, the more if they connect to all-time highs, then for sure you know that line is primary. If there's resistance on that line, stay out. If it breaks out, you're looking to have a good surge in price. This is Eric Mwathe with Mwathe.com. Peace and blessings.